Yes, good morning everyone. Hope everyone is doing well and hope your preparation is going well. And welcome to Vijay Mohan IAS Academy, and this is Vijay Mohan. As you know that we are in the module of TSPSC Group 1 Mains Paper 4 video course and test series, right? So as part of this, in the previous video we had a discussion about national income accounting and what is the significance of national income accounting. We had a discussion about significance of national income accounting, right? Then we had a discussion about what are the main concepts related to national income, and under these main concepts we had seen about GDP, what is GDP, what is GNP, what is NNP, and what is personal income and what is personal disposable income. And we had seen that what are the recent changes being incorporated in measuring national income, and we had seen the previous year questions on these issues, and I also gave some practice questions for your practicing concern, right? So in this video or in this lecture, we will be going through the remaining aspects of measuring national income, right? First, we will be going through what are the various approaches to measure national income, and then after this we will be dealing with what are the challenges or what are the problems while measuring we will face while measuring national income, right? After that, we will be seeing some of the limitations as far as national income is concerned to represent the welfare of people. If you observe, there are some limitations as far as GDP is concerned for representing the welfare of the people as a whole, right? We will see that also, and finally we will see what are the factors or what are the issues that affect measuring national income. These issues we will see in this video, and then we will see some of the previous year questions which are being asked in these topics, and we will see some of the practice questions, right? Okay, now first we will see what are the various approaches to measure the national income. See, this issue is very important because there was in 2018 APPSC there was a question on particularly directly on this issue that explain or I think describe the various approaches of national income, right? So basically, to measure the national income there are three approaches, basic three approaches are there, right? We will see one by one. In India, GDP is estimated by Central Statistical Office, CSO. There are three different ways of estimating the national income of a country, and these three methods are: one is value added method, you can say this one as the product method, and then the income method, and the third one is the expenditure method. So these are the basic three measures as well, three approaches to measure the national income, and you try to remember these three. Like value added method, it is obvious in their names itself, they are telling that it is a method which is based on value addition, that is value added method. And second one is income method, it is a method based on measuring the incomes, right? Then third one is the expenditure method, it is the method which is based on calculating the expenditures, right? We will see one by one so that you will be able to understand the concepts a little bit easily, right? Now see here, value added method. What is value added method? See, under this method the GDP is calculated at market prices, which is the total value of outputs produced at different stages of production. As we already told that this is based on production. So here he is saying that it is nothing but calculation. It is calculated at market prices, and it is nothing but total value of outputs which are produced at different stages of production. So if you take different goods and different outputs at the different stages of production, and if you calculate those the value of those outputs at different production levels or production lines, then you add all those things, then you will get the national income. And in this method, if you calculate the national income in this method, then it will be called as value added method, right? Now caution should be taken to take final goods. Here the caution is that you need to take the final goods only and not intermediate goods, as it will result in double counting. As I already told you in my previous lecture also, that you should be taking care that you should not count them as two times, right? So for that you need to take only final goods, not intermediate goods, correct? Right. Then second method is income method. See, name itself is suggesting that this is based on calculation of income. Whose incomes? The incomes of citizens or the incomes of households will be calculated in this method, right? Now observe, this approach focuses on aggregating the payments which are made by firms to households. They are called as factor payments. See here, before approaching or before understanding this, you need to understand circular flow of income. Actually, circular flow of income, it will not be very useful for your mains perspective, but to understand income method, you need to know about the circular flow of income. In previous class also, I explained you briefly about what is the circular flow of income. In a circular flow of income, that is in a simple circular flow of income, there will be two entities. One is households and another is firms, right? Firms. In a circular flow of income from households to firms, factors of production will flow. Factors of production, right? What are these factors of production? Land, labor, right? Capital and entrepreneurship, right? And for these factors of production, firms will pay factor payments. Right? For land they will pay rent, right? For labor they will pay wages, for capital they will pay interest, and for entrepreneurship or organization they will pay profit. So this is the simple circular flow of income that you need to remember. And now in the income method, the approach focuses on aggregating the payments which I told you, payments by the firms, that is factor payments, to the households for their services. And those payments are called factor payments. So if you aggregate the total amount of the factor payments which are paid by the firms to the households, then it will reflect a national income, and this type of method is called income method. That is the basic idea, right? This gives the national income defined as total income earned by the citizens and businesses of a country, right? Then there are four types of factors of production, I already told you, and four types of factor incomes accordingly, that is land, labor, capital and organization as economic factors or factors of production, and for this respectively rent, wages, interest and profit as factor incomes correspondingly, right? Then you have to add indirect taxes, right? Just a minute. Then for these factors of payments, you need to add indirect taxes, then you need to subtract subsidies, and then you need to add depreciation to get GDP, right? In a mathematical sense, you can represent GDP through this method. In this method, GDP is equals to wages plus interest plus rent plus profit, then dividend also, then indirect taxes, then you need to subtract subsidies, then you have to add depreciation, then you will get GDP. This is the mathematical representation of GDP as far as income method is concerned, right? Then we will move to the third method, that is expenditure method. See, the name itself is suggesting that it is expenditure method. So this calculation of national income in this method is based on the aggregation of expenditures done by households, firms, government, and also calculating export and import income. Right, now we will see the expenditure method measures the final expenditure on GDP. It is not intermediate expenditure that you are taking into account. You are taking into account final expenditure on GDP. Right, the amount of expenditure refers to all spending on currently produced final goods and services only, on final goods and services only in an economy. It is currently produced, again you are using word final goods and services. See, wherever you are writing about GDP, try to incorporate final word so that your answer will be very perfect, very succinct, and very according to the correct definition of GDP, right? Okay, so in an economy, in an economy there are three main agencies. Which buy goods and services. And what are those agencies? That is households, second one is firms, and the third one is in the government. See, these three entities are very, very important as far as your calculation of national income, as far as this chapter is concerned, and also Indian economy is concerned. You need to remember these three entities, that is households, firms, and the government. Why? Because they will keep on coming again and again, right? So in an economy, what are the three entities that are going to spend to purchase goods and services? One is households, then another one is firms, and the government. So if you aggregate the expenditure which is done by these three entities, then you will get the total national income, right? Now the final expenditure is made up of the sum of four expenditure items. So these three entities will make four types of expenditure entities, four type of expenditure items. If you include these four expenditure items, then you will get the final value of national income. Then we will see what are those four expenditure items, right? The first item is consumption. Which is done by the households, right? Then investment expenditure, which is done by firms or businesses, right? Then government expenditure, which is obviously done by the government, right? Then net exports, which is nothing but imports minus exports, right? Which is representing external economy. This is called net exports. So these are the four expenditure items that we need to include while calculating the national income in expenditure method, right? Now in a graphical representation in this method, GDP can be represented as GDP is equals to C, that is consumption, plus I, that is investment expenditure, plus G, that is government expenditure, plus X minus IM, that is net exports. Okay, so this is the approach, or this is the basic, these are the methods that will be employed while calculating the national income. Okay, now we will see one of the previous question that is being asked in APPSC 2008. This is a direct question. Explain various approaches to measure national income. So you can directly, first you can basically define what is national income in 2 or 3 sentences. Then you can tell that these are the various approaches, these are the 3 approaches that are being employed to calculate national income, like value addition method or production method, income method or expenditure method. Then after that you can explain each and every method in 4 or 5 sentences, and you can give some of the examples so that your answer will be complete and your answer will reflect a value addition, right? So this is the direct question. Explain various approaches to measure national income, which is being asked in 2008. So there is a tendency as far as TSPSC or these state public service commissions are concerned that they will repeatedly ask some questions. So there is a possibility that they might ask this question. Maybe they will change the tail word, like explain, instead of explain they can ask discuss, right? Discuss various approaches to measure national income, or they can take one single or 2 single methods, like explain the following in explain the following briefly, like value added method or value addition method of calculating national income or income method of calculating national income. So just try to be thorough. See, జాతీయ ఆదాయాన్ని కొలవడానికి ఉపయోగించే వివిధ పద్ధతులు రాయండి, రైట్? Now we will move into what are the problems in measuring national income.